to say the least, in part due to the large-scale investments made into digital health and the consistent wave of IPOs that have made industry headlines. This next panel explores how all this activity is affected by a global pandemic, the gaps in our care systems it strives to fill, and how investors are looking ahead for the future of healthcare. Please welcome Matthew Holt.
Hi, this is the Never the Same Investing for a Pandemic Resilient Future panel. I'm your host, Matthew Holt. I'm the publisher and founder of the Healthcare blog, and I've been hanging out with the folks at G2A for quite a while. I have a great lineup here with me today. Three amazing venture investors, and all of them share a certain agenda, you'll see, and we'll talk a bit about that later on. But who have we got? Jessica Zeke. Jessica is the partner at Telehealth Ventures, which is the joint venture fund of three blues plans, I can remember these days, but certainly the Blues of Oregon and the Blues of North Carolina. Maria Velaceres is the founding partner at Steel Sky Ventures. She's had a wide and varied career in marketing and has done some really exciting stuff, and we'll talk a bit more about that. And then Lisa Surin is on virtually every panel ever to do with venture investing, great friend of all of us. These days, hanging her hat at Manat, the sort of law firm plus consulting plus venture fund, but previously at GE, where, by the way, Jessica was as well, and also way back when, but relatively recently when, partner of the Silos Group, and best known as the blogger behind Venture Valkyrie, or the actual Venture Valkyrie. So here we are. We're going to kick off the session, and I'm going to start the conversation about what has changed and what we're thinking about the state of health tech and digital health investing today. So Jessica, why don't I start with you?
Great to be here, Matthew. Jessica Zeski, Telehealth Ventures, where we do invest on behalf of Cambia and Blue Cross North Carolina. State of investing actually is busy, and it's sad that it is, but in the midst of the pandemic, in the midst of rapid change, is actually a time of great opportunity also. There are consumers using and patients using healthcare in ways that obviously through telemedicine, the demand for mental health services, which are so needed. These are real trends that we see staying on. And so I would say it is any time of rapid change, like we're seeing right now, is a time to try and put money to work in those rapidly changing companies.
Maria, tell me about your what your view of the state of play is right now.
I think the state of digital healthcare has really accelerated. There's companies that we invested in 3 to 4 years ago that we thought would, take some time to gain traction. And post-COVID, they've really accelerated. And this is not only progressing the state of healthcare in general, but also just the state of access to care in ways that we haven't been able to before, and equal access to care. And so we're excited about these new technologies that are gaining quicker adoption, and we think they'll ultimately lead to better health outcomes.
And Lisa.
Well, I think a lot of it's been said, but what I think is really different right now is the amount of concentration of capital that's going on. So a lot more money being invested this year in digital health, but a lot fewer deals by a long shot. So the average deal is somewhere between 25 and 30 million. And we know that it's mostly late stage and seed stage. So the middle is getting left out. And I just really wonder about how that bodes for the long term capability of the field.
So, Lisa, I've had this conversation with you many times, and I'm going to ask you, back in, I think, 2016 or 15, I forget which year, you told me it was all too expensive and valuations were way too high. Interesting. I can't remember, Jessica, when you got to Echo, but you were a relatively late investor in Livongo. And let's just take Livongo, Teladoc, a couple of the others, and maybe some of the others like One Medical, who've now made it to the public markets. We've had those IPOs we talked about. We have by any means, any measure, very, very high valuations currently there, and those are somewhat being reflected in the private markets. So, Lisa, what's the state of play of valuation? Is there anything worth investing in now? Or is it all too damn expensive?
That's so complicated to me. I mean, I did expect the valuation bust to come long ago, and I obviously was wrong about that. I don't understand, frankly, the price of things. It's very hard to imagine that some of these companies are worth the price tag that's on them. effectively in a normal market. So I still am very reticent about a lot of the deals. I certainly missed some good opportunities to exit. I think if you're a long holder in some of these companies, it's going to be more challenging.
Jessica, you guys have got a number of these investments at Echo, and obviously some of the ones you did at GE have been back then have been subsequently raising money like Evolution and others. Just what's your thought about where you can put money to work that makes sense for now?
Oh, can we go where the puck isn't? Like, I think the where to put money to work now is in areas that are not where there's so much demand to put capital to work. So a lot of spectator funds are coming in and trying to put money into healthcare. It's seen as more stable. It's seen as demanding. Obviously, our IPOs are doing well in this, yeah, so for now in this market. And so the number of funds and the capital overhang means that there is a supply of capital out there that is going into some of the early, maybe what they perceive as earlier and easier wins in the later stage insurance companies, in the telemedicine companies, in mental health companies, which are not easy business models. Let's just be clear that getting to the actual exit is going to be very challenging. Where I'm seeing, valuations that we can stomach, I will say, we go back into some more of the roots, like where are the insurance infrastructure and data plays that potentially not every investor is interested in? Where can we look at some of the affordability of healthcare and care delivery? Where can we look in rural and remote areas that not every investor is clamoring and pounding down CEOs' doors to get into? That's where we're seeing more valuations that are, I don't know if appealing, but something we can get behind.
Maria, on that, you've been, I think, a little more active. Maybe you, in your earlier statement, you were suggesting that there's more activity. You're more interested, and I think many of us have looked at the sort of the quote unquote rationality of some of the valuations of the loss-making companies that are public and gone, well, that's crazy. But they are sitting on huge amounts of stock, and you can imagine more M&A is going to start coming, especially post the longer mode. So where do you think the areas are that you're looking to invest, and where do you think the exits are going to be?
I think you really have to find companies that can fill gaps that these larger players haven't addressed. So for instance, we're looking at the Medicaid market. There's not really a lot of activity in that space focusing on telemedicine to this market because it's a harder journey to take going on to getting all those approvals. So we're looking for companies that can fill gaps because these larger companies are going to be so flush with cash. Like you said, they're going to be looking to deploy. And so we're looking for some of these acquisition targets. And we still have the ability, being early, late seed series A, that we can get into these companies at decent valuations while they've been inflated, maybe in the later stage. In the earlier stage, we're not seeing that much mispricing. And I think that they've actually been priced accordingly to, where they should have been. Because a lot of these companies that we're investing in are women's health companies, which have traditionally been undervalued. And so now we're seeing them start to get a fair shake. And we're hoping that they'll be able to take advantage of this acquisition frenzy that's about to take place in digital health and telemedicine.
Yeah, I mean, it's a very interesting concept because, can you get pricing now that is good enough for the long term? Because again, if you look at the companies that made the IPO, even the ones that have been acquired, almost all of them are not. There aren't many Instagrams here. It's not like, you get the $1 billion acquisition after 12 months, right? Most of these are ones that, if you go back to practically all of them, sort of launched at the conference that I co-founded with Indu, which is Health 2.0, which included Frisia and American Well and Livongo. Mm-hmm. And Livongo, it's the most recent one, but it was 2014. It wasn't an overnight success.
What I think changed though is if I'm just looking in like the data space, the number of billion-dollar acquisitions in the last 3 years, if you include Cover My Meds as a partial data company, and you say Nant Health and Modal and the NaviHealth and other companies like that, that's different than it was 10 years ago. Like, we didn't see that many billion-dollar acquisitions in each vertical, and so that's opened my eyes a little bit to when you have a new entrant. The ones I'm watching are where you're really creating a new market, like Health Catalyst. Like, I'm really interested in watching that one over time. And Frisia, what can we have category creators survive in the long-term public markets and they start to acquire companies?
I've been really struck by the fact that so many of the companies getting so much of the money this year are really turning into commodities. The products they sell, like telemedicine, is largely becoming a commodity. Like pharmaceutical delivery. I mean, really? I mean, that's So I really wonder about the sustainability of some of these prices and the ability they're going to have to acquire, because you can't keep up the value with a commodity product. And I think there's some that we know that recognize that. But I also think those are going to have to, that means that I think the younger companies have to be very capital efficient, have to have reasonable valuations for a while, and have to not overraise in order to get a decent return, when they get acquired. So the companies that are coming out of the gate raising $100 million in their Series A handicap themselves, I think, from that acquisition opportunity.
So is that not all your fault? On the grounds that there's now so much money, in venture capital, and I have a lot of young companies I work with, and I send them off to places, and they come back saying, yeah, the venture investors all told me we're not raising enough money, because you've got to put so much money to work. You see these huge funds now being raised by folks like Oak and others, where they're raising $1 billion funds. They need to make the $50 million, $100 million investments. How do we get venture to be rational?
I'm not sure, there's a lot of smart people in these funds. I have no doubt about it. The really big $1 billion funds. But I think, traditionally that is not the model that worked in venture capital. Traditionally, the model was $100 million, $200 million funds. And we haven't had that kind of inflation over the time that these have grown. So I don't know. I think it's a really different approach, and it's going to be tough not to take more of a PE approach with that kind of money. You can't really manage effectively 100 little portfolio companies that are still trying to figure out their business model. So I think it's going to be, and it's why we're seeing the rise of all these micro funds that are, raising $10 to $50 million to try to come into the earlier stages. But that's also a tough strategy. Yeah, it's also a tough strategy because you can't do the follow-ons, and God forbid the bubble bursts while you're still standing up, you're going to lose a lot of equity value. So it's a very challenging time, I think, both for the venture community, which doesn't have to prove itself for 10 years after it makes its investment. So that you get some grace period, right? And also for the entrepreneurs, because I think the lure of all that capital is pretty sweet.
I think it is, but for the smart entrepreneurs, I think they understand value. They're understanding valuations in a way that they haven't before, because they've seen a lot of failures, and they've seen a lot of people fail because they went out to the market with too high of a valuation. And I think the market doesn't have the appetite to do that anymore, at least the smart healthcare investors. We've seen, some celebrity investors and things like that will get into these hot deals and drive up valuations with nothing really to back it up. But I think the really smart founders and the ones that I'm investing in are the ones that understand that just because you have a high valuation doesn't mean your company's more or less successful. And I think it's getting into that mindset and getting out of this rat race of whoever raises, the most is the winner. I think that's kind of something that we really have to continue to socialize with the entrepreneurs.
So we're blaming Ashton Kutcher and Serena Williams for the whole
No.
Jessica?
I would say there's a fundamental difference as you're looking at syndicates now. Are you syndicating with other funds who understand that it's going to be, 18 to 24 month sales cycles for some of these enterprise deals? You're going to slog it through, and you stay in it because you can get some fantastic returns in healthcare services, healthcare IT by playing that. And then you get some triples and you get some, a few doubles, and that's how you make your fund work. That's really different than a Silicon Valley, more tech fund that says, I'm going to place 10 bets, walk away potentially from 9 of them, and 1 of them needs to be a unicorn. Those two models don't invest that well together. And so making sure your syndicate is aligned on what type of company you're investing in and how you're going to go about this is more important than ever.
So let me pick up on that, because you raised the point which I always badger more of my friendly VC or my VC friends with, which is, are you in general seeing investments, do you like investments in companies that are going to service the incumbents? or as some of your colleagues have called, some of your colleagues have called it, Jessica, the innovative incumbents, if there are such a thing? Or are we looking for the next Amazons and Airbnbs? People are going to blow, Ubers, who are going to replace the incumbents. And you can look at the public markets and say that, it's unclear. It looks like America is servicing the incumbents and Telehealth and Livable are maybe trying to replace them. Not clear. It certainly looks like at Oak Street, it's out there to replace incumbents, whereas Fraser is servicing incumbents. Where are you placing your bets, and which ones do you think are more likely?
I think you got to try a little bit of both. I mean, I think you can't assume that healthcare companies that are long established are going to disappear overnight. And there's a lot of competition coming from some of the big companies, United and Humana, and others are buying up practices at a huge rate. They are the competitors, ultimately to some of these other primary care networks and the like. And there's a lot of interesting and effective ways to support them and to make great money with companies doing that. And at the same time, you have to be putting a few on, betting a few on black over there and hoping that something's going to turn up from your future thinking that will be the inoculation against those companies, ultimately, some of them being replaced. Most companies do not live as long as they used to. The Fortune 500 turns over very fast these days. And so you really have to be playing both sides of the market if you want to please your LPs.
Yeah, that is true. But I think you could argue that healthcare is the exception to that. If you get on the list of the big brand names, I mean, if it starts with the name Blue, or it starts with the name Mayo, Johns Hopkins, or Pfizer, it's been around a while. You'll see them fall off as quickly as, say, some companies that a company you may have been associated with.
Yeah, no, I think you're right. I mean, I do think you're right, but I do think there's a lot of new names when you list out, successful healthcare companies now. Nobody would have put Amazon in that list 10 years ago. Nobody put Walmart in that list 10 years ago. And I know those are big companies. They're not young startups, but nevertheless, they're building around young companies.
So let's switch a little bit and talk about two of you are corporate VC investors, and obviously we're here at the Bayer G4A kickoff, which has been a program going on for some years now, helping in general very small companies, probably many of whom are well pre any kind of serious investor interest, raise hundreds of thousands or maybe tens of thousands rather than millions and millions of dollars. What do you think the role of these innovation groups, whether they be at pharma companies or health plans or even hospitals, have been, and all the sort of associated hangers-on, be it the Rock Health or Startup Health, have been in sort of promoting the growth of good companies, or do you think it's mostly sort of a lot of theater without too much result?
I think it's both, right? Depends on who you're looking at. There's a lot of innovation theater out there, companies that spend money on incubators and accelerators and pilots and never do anything. And then there's companies that really nurture these relationships and find partnerships through these activities and bet on things they already plan to use. And those are great, partners to have. I think the trick here is, if you're the entrepreneur, is trying to figure out which one you're talking to, and talking to other companies that have worked with them and understanding whether it's talk or action.
Lisa, exactly. And as entrepreneurs are looking at the funds within corporate, within strategic, which again, let's look at 25 to 40% of all deals involve either some sort of corporate VC at some point now in the healthcare sector. It's because they, for a lot of reasons, but they looking at the structure of how the fund in quotations is set up is really important. How are they staffed? Do they have a dual mandate? Do they require contracting? What's their ability to follow on? All those things, I put some onus on the entrepreneurs to also be really assessing what the fund looks like. You look at Ascension, you look at Kaiser, they've stood the test of time because of some of that discipline that they've had on how they invest, who they hire, and the structure of it. And I think we need to just continue to challenge corporate funds to look at those models and say, how are you going to be sustainable so that you're not one and done, you're not moving with the stock price of a company, of the parent company. So it's really important to have that long-term sustainability.
So Jessica, let me push you a little bit on that, because you kind of leapt a little bit to the next question, which is the role of corporate venture funds as opposed to sort of corporate innovation programs. Sometimes those two things are connected closely. Sometimes they're not. G4A doesn't actually have a recognized sort of follow-on venture fund. I don't believe Echo has innovation. I know Cambia Grove, right? Has up in. I guess it's not. It's connected. It's in the family, right? Connected to you. So, how do you think those two things are playing together? Because obviously the stage of company is somewhat different. The stage of investing company is somewhat different.
I think they can actually work. I think, again, I'll come back to how they're structured. How do they play together? I actually haven't seen that many examples of them playing together very well. And I'd be looking to my other panelists to give examples of that. I see some great innovation engines out there that are standalone, and I see some great strategic funds. I don't have a great example of two. I will say, Cambia Grove's a very valuable partner of us at Echo, but there aren't that many examples out there. Maybe you two have other ones.
No, and I think to your point, it's really confusing. It's really confusing for entrepreneurs to understand who they're talking to. At one group, the innovation group can deploy capital. Another group, it's a venture group that can deploy capital. And so I think just as we got confused with the semantics of it, I think it's really confusing for people to understand, okay, if we're doing an innovation project, does this lead to a pilot? Does this lead to venture funding? And I think it's really on the corporates to make sure that they're more clear. And sometimes they're just not clear themselves. They're throwing these programs together. They are trying to help, but they're really just trying to source deals. And it's just like to be honest and clear with what the program is and what the outcomes will be. And so a lot of times we try to figure out what that is up front and have entrepreneurs talk to other people who have been through these programs, because quite frankly, a lot of them haven't had a lot of success and they've wasted a lot of time. So it's really important, I think, to understand exactly the clarification of the program and the outcomes to determine if it's going to be worth the time for entrepreneur or investor, spending time building that relationship.
I think a challenge starts a lot of times inside these organizations where they kind of want to get in on the action, but they haven't sat down and said, what is the objective?
Exactly.
Usually the objective on the innovation side is to improve the core business in some way. And it may be in the short term or the long term, but is to advance the interests of the core business in some way. Usually the interests of the investment side community, at least the external one, is to make returns, and parenthetically to disrupt the existing, hierarchy. And it's really tough for big companies to undermine themselves. Nobody likes to set themselves on fire. So they really have to distinguish what their objectives are in each of these initiatives and how they're going to go about it and how they're going to measure success, because they may be measuring success by disintermediating one of their existing businesses, and they have to be comfortable with that and know what they're doing with their eyes wide open. I think it's a really important step. I spend a lot of time with companies on this now as an advisor, and it's always amazing to me how few of them have spent the time talking about how they're going to measure success from the beginning.
Yeah, I've been consulting with large companies for 30 years. I'm never amazed about how little thought goes into a lot of things. There's a huge mergers and acquisitions, which you understand. But you are seeing some interesting plays now with companies, big corporates directly investing. I mean, the Bear is one, right? It's directly invested in one drop and put some of that money to direct investment, and some of it sort of, if you like, future activity based. But then you've also seen. And the other historical thing was that you didn't expect corporate VCs to actually be significant contributors to the bottom line. But I would guess that a couple of recent sort of wins in digital health. I mean, I suspect what Merck just returned on their investment in Livongo is probably pretty good for a profit of one of their big drugs these years. So I think things are somewhat different than that as we used to think.
Yep.
All right, let's turn to an issue which I think is we can't ignore given the state of who we have on this panel. I'm the token male here, right? But we've talked a lot. There's been a lot of discussion about ethnicity, gender, and who knows what else in terms of Me Too, Black Lives Matter, and elsewhere, and the response from investors in digital health. There's been a lot of discussion, a lot of talk. What are the three of you, given that you are all still incredibly small, minorities in terms of the number of women certainly women of color in your case, in the seat you're in, what are you seeing going on in your own industry regarding this issue?
I'm seeing I'm seeing sort of two sides of things. It's sort of interesting.
With a big size.
I'm very bifurcated today. On the one hand, there's a lot of incredible effort. I think it's really interesting right now. We're seeing two sides of a coin. On the one hand, I'm seeing a lot of women and people of color take matters into their own hands and say, to hell with this, I'm going to start my own fund. I'm not going to wait for the incumbents to recognize that I have tremendous value to add here. Unfortunately, they're rarely able to raise more than very small funds at the moment, but it's okay. First time funds, you got to start somewhere. On the other hand, in the larger world, not just in venture funds, we're seeing women and people of color take sort of unequal hit in terms of a step back in their careers. Women, regardless of color, tend to take most of the childcare responsibility and other responsibility. And as the economy has contracted, and families have to make choices, women are losing their career trajectory at a pretty unparalleled rate. So I don't know, if we'll look back at this moment in time in 5 years and say it went ahead or went back, but I fear it will go back, especially if the stock market doesn't hold up.
What's kind of changing right now? And I would say we now have more data than ever before. It's being talked about more than ever before. But I'm waiting kind of with Lisa. Like, I want to see more action at the senior level. We're still, if 1 in 10 in VC are decision makers who are women, who are people of color, who are actually the decision makers and the check writers. I want to really watch that over the next few years. Are we going to see real differences in that? Because we now have the data to back up that returns are stronger, boards are stronger, et cetera, with those types of hires. I will put some of the onus on LPs to be making sure they're holding the general partnerships, the funds. To get funds, you need to start showing demonstrated evidence that you're changing your hiring behaviors, your recruiting behaviors, your sourcing, moving forward.
And from my perspective, being a new GP, one of these who's just, gonna pioneer it ourselves while, instead of waiting for Silicon Valley to open their doors. We've, like Lisa said, it's kind of a struggle because even though there's these newfound interest in helping people of color or women, you usually sourcing from a smaller bucket, right? And so they're not even treating you like they're treating the majority GPs out there. So because I'm a woman, I have a healthcare fund, but because I'm a woman, because I'm a Black woman, they're putting me in a diversity bucket. They're putting me in another bucket with smaller amounts of capital. And so that's one of the reasons that we're raising smaller funds. We're not able to access because they don't think about us as somebody that could be in the large bucket for their LP platform. So that's one of the struggles that we're having in raising bigger funds. And I think that we don't want more special treatment and special programs. We just want a fair shot. And so I think that this catalyst to try to do some special programs is almost been detrimental, but it does bring awareness and it does begin to highlight funds and highlight people in the space. And now that they can't claim that there's not enough venture funds or not enough, Black founders out there because we are out here, and I think they're finding us. So that's great. The visibility has been great. The dollars have not been great. And so hopefully that will shift. And to Lisa's point, we'll be able to raise bigger funds so that we can better prove ourselves, because we want to be able to enter these deals writing meaningful checks. And not everybody wants to have a seed or pre-seed fund just because you're a person of color, right? So I think that the ability for LPs to expand the universe of who they think can do well, when that changes, then we'll be more empowered to make more change and more headway in the space.
Maria, when you go to talk, because you're actually raising, having to raise funds directly, you're not one of these nice cushy corporate funds where,
right.
where someone's writing a check for you. When you go and talk to these LPs, are you seeing any changes there? Are they looking more diverse, or are they a bunch of old white guys in suits still?
I think you see both sides. I think they have very well-intentioned the programs, but they set barriers that we can't meet. So, they know that there's not that many Black women and people of color that have been GPs at Sequoia, but yet we're looking for somebody who's spun out of Sequoia or Google Ventures. If you have that, then, you can check the box. But so they're creating these programs, but they're creating barriers that we just can't meet. So I think that's a kind of a disconnect there. But that's what happens when you don't have diverse people at the table helping to create these programs. You get into situations like that.
Yeah, I was listening to an NPR program about the Fed, the Federal Reserve, the different Federal Reserves, and the efforts that one or two of them have made to diversify, and in the end, how much better it made them, but they had to go through the program of doing it. And I think that has to be done, across the board, across corporate America and in many places. And then again, as Lisa pointed out, you have to start at a much earlier place, which probably starts with early childhood education and school and housing and a bunch of stuff that we don't talk much about. That's probably out of our scope. All right. Well, we only have a few minutes left, and I'd like just to go around the three of you and talk about where companies that you either put your money in or you wish you'd put your money in. I might go back and ask Lisa who she missed out on in 2015. But who do you particularly have either made an investment or you like? So let's pick a particular company for each one of you, and then and then just a lightning round about that company, and then if we have a minute at the end, I might ask you what your big miss. But let's start with where you either put money or you'd like to put money in a company you really like. So I'll start with you, Jessica.
I will have to say, I remember, and now we talk about valuations and we talk about challenges, things like that. But I remember sitting across from Rashika, who was the CEO and founder of Iora, probably 7, maybe it was even 8 years ago. And with the very first pitch, and he came out, and I remember trying to get my brain around what it sounded so interesting, but couldn't quite get my brain wrapped around everything that he was talking about doing and the risk and the care delivery, and none of it had really been proven. I'd take a time machine and go back to that meeting.
Okay, do you have one that you have put money in that you like?
So I am really excited about where Genome Medical is headed. I think the role of genomics in care delivery is something that is it's really going to be a game changer in the next decade, and making it affordable and accessible from the front end through making sure that there's the right test made for the right person is going to be a great opportunity ahead for Genome Medical.
What stage is Genome Medical at, and who is their customer?
Genome Medical is still fairly early stage company. They're at the Series B investment stage. Their customers are health plans and large provider groups, as well as they do work with some labs.
Fantastic. Maria, who do you like? And then I don't know if you've missed one that you want to talk about, but I mean, they're both good questions. So tell me who you like.
Well, we recently had made an investment in Lark, and we were really excited about that, especially considering the bubble that we have with these inflated IPOs and acquisitions. So they're basically an AI version of Livongo. So we're super excited about the exit potential there. Another company that I think is interesting, we're looking at next generation delivery models. And so we've been looking at a company called Zipline that I think is interesting. They've, are delivering prescription drugs. And as we think about the Amazons and these tech companies getting into the healthcare space, it would be interesting to consider how they plan to deliver these without having their own pharmacies. So those kind of next generation, really pushing the envelope companies are something that's been interesting to us.
Yeah, you're never alone with a drone, as I say. Lisa, who have you put money in that I don't know what you've been doing actually while at Manac, because you're no longer a full-time you have another day job as well, which is running.
Yeah, well, I'm running the fund at Manat, and it's been really interesting because we're not sector specific. So we're doing healthcare and health tech, but we also do non-healthcare, which I got to say is a lot easier to do, or at least it feels easier.
Well, that's because you don't know as much.
Yeah, it's a blessing, let me tell you. I really, on the healthcare front, I've been really a big fan of Health Reveal. I've been banging that drum for a while. They're now really reaching a growth inflection point. They're a company that mines data to help do prescriptive analytics, so identify people who are getting care that's not in line with evidence-based medicine and making sure that people avoid material adverse events. I think there's a real opportunity there, and Lonnie Reisman, who started that company, has been down this road successfully before, so I'm hopeful he will be down it successfully again. We also were lucky enough to invest with Jessica in Genome Medical. The deal I missed that I wish I'd understood at the time is GoodRx. I mean, my God, at the time when I saw it, I remember thinking it's a coupon company. Who cares, And now, I mean, they've just knocked it out of the park. I tip my hat to those guys. I got to tell you.
Yeah, I still think they're only 10% of the company. I keep on trying to collect from Doug, and he always trying to be. Yeah, that's good. Well, it's really great to have the three of you as leaders on the venture investing side. I'm really pleased that we could put this together for G4A. So I've been talking with Jessica Ziesky, whose name I can never pronounce, so I apologize, Jessica, for maybe from Echo Health Ventures, River Ceres from Steel Sky Ventures, and Lisa Suman from Manat. This is Matthew Holt signing off. Thanks for your time.
Bye-bye.